Thanks again for joining us today for our third quarter 2025 review and market outlook webcast. My name is Mike Musio. I'm the president of FBB Capital Partners, and I'm joined by my colleague Mike Bailey. He's our director of research and chair of our investment committee. And Katie Bugley is, as always, handling the technology behind the scenes here for us. Today, we'll review the third quarter of 2025 and look ahead to what may lay ahead for the balance of the year for investors and how the fourth quarter might be teeing up 2026. We'll have an opportunity for Q&A as we go along on the fly, if you're so inclined, and certainly at the end of the call. So you've already had half a dozen or so questions submitted beforehand from folks. We'll certainly get to those. And then I'd ask you to take a look at the bottom of your Zoom screen there, right in the middle leftish, I guess, on my screen. Middle right, says Q&A. If you click on that box, you can fire off a question. That question will pop up to us, and we'll be sure to get to it. To the extent that there's some questions that are similar to others, I'll try to condense those on the fly and consolidate so that we have time to answer as many questions as we can with the time that we have allotted here today. Finally, as you heard at the top there, we will be recording the call, which will be posted for replay on our website probably tomorrow, but certainly by the end of the week. And as we begin the discussion, let me remind you the fact that today's commentary is based on the facts as we see them today, which of course are ever changing. We got an ADP jobs number today. We might not get the BLS job number on Friday because the government presently isn't open, so we will see. Please note that any reproduction of or transcription of statements made during this call without our prior approval are prohibited. Did you know someone who you think you would like to listen in? You can direct them to the website where they can find the recording that I mentioned. And finally, please note that all forward-looking statements made during the call are subject to risk and uncertainty that could cause actual results to differ materially from the expectations and assumptions that we discussed today. Please review the complete compliance statement and disclaimer at the end of the webcast. And when we wrap up and start the Q&A, you'll have a moment there to review that. So with that, Mike, I think we're off to the races. So I'll turn it over to you, please.
Okay, great. Thanks, Mike. So a common theme that we're seeing in today's markets is increasing pressures. And today we'll discuss some of these strains, including day one of the government shutdown, along with some other pressures building across the economy, the Fed, and capital markets. We'll then lay out our positioning, which tries to balance some of these short-term pressures with a long-term investment horizon. Then we'll wrap up with your questions. Next slide, please. Okay, as Mike Musio mentioned, we are in the middle of the early parts of a government shutdown. I think many longtime DC residents probably lived through other shutdowns similar to this one. And if this go-around is anything like the prior experiences, we're unlikely to see significant downside to the broader economy or markets. However, a protracted shutdown could lead to a decline in the DC economy, for example, especially if the administration uses this shutdown to increase permanent layoffs. Additionally, a lack of market data, including a jobs number expected on Friday, again, which Mike Musio also mentioned, that could increase investor uncertainty and add to market volatility. And that's at a time when markets are generally expensive. So we are keeping an eye on this particular shutdown cycle. This dynamic could also potentially threaten a mainstream view of steady economic growth. So worth watching. As we are monitoring this unfolding shutdown, let's put this event in a broader context of other factors impacting the economy and markets. Next slide, please. So as we try to understand some of the economic and market pressures, we're changing things up a bit and starting with a couple of insightful client questions that came in ahead of time. I think really get to the heart of the current investment debate between bulls and bears. So the questions are, and these are sort of combined, if tariffs remain, prices continue to rise, and job losses increase, could we have a recession in the next 12 months? And how do you see the coming year in the market? So really, I think very good questions. I think a lot of investors are asking very similar things. So let's try to summarize that. From a base case perspective, our expectation is that tariffs will gradually add a little bit of upside pressure to prices, probably not a ton more, but a bit more. Layoffs may also worsen a bit, but a series of Federal Reserve interest rate cuts is likely to help ease some of this pressure and to help us avoid a recession. Additionally, if we stick with sort of this base case of modest economic growth and continued growth in corporate profits, I would expect average or perhaps a little bit below average market returns over the next year or so, especially if some of the optimistic sentiment that we're seeing starts to fade a bit. We'll get into some details on that shortly. So with that as a kind of an executive summary, let's put some meat on these bones and get into some of the details backing up these expectations. Next slide, please. Okay, so while markets and the economy appear to be performing pretty well at this point, if we go back to April, it was a very different story, almost the opposite. After the administration's Liberation Day tariff announcement, led many to expect a big spike in inflation and rising recession risks that really took stocks to the edge of a bear market. Since then, however, we've seen a moderation in tariff policy, although as these actual tariffs do continue to kick in, we are seeing some modest price increases, roughly around the 3% range. We could see a bit more if tariffs continue to kick in, especially if they impact the holiday shopping season. So in sum, while we see the tariff and inflation pressures rising a little bit, we think they're somewhat manageable for now. So with that, let's move on to the other major swing factor in the economy, the job market. Next slide, please. So job creation has been relatively steady since the end of the pandemic. You can see some of the data here with the chart, although we are seeing a gradual rise in unemployment here, kind of with the red circle, and essentially a slowdown in hiring. Now, the question is what's driving that? It could be a combination of several factors. We are seeing changes in immigration policy. We're seeing artificial intelligence potentially impact demand for some types of jobs. We're seeing worries over tariff policy impacting, hiring managers, or perhaps this is just the business cycle. So regardless of the reason, it appears that preventing layoffs and avoiding a major recession has really become front and center for the Federal Reserve as it tries to set monetary policy. So with that, let's turn to some pressures on the Fed on the next slide. So we just mentioned that Jay Powell and the Fed are monitoring pressures on the job market as they continue along a path of cutting interest rates to try to boost the economy and lower the recession risk. But Powell is also seeing pressures in other areas as the clock winds down on his term, which ends next spring. From a personnel standpoint, we're seeing the administration try to add some outside pressure and change the committee that sets interest rates. Interest rates, that's one issue for Powell and the committee. As we mentioned earlier, when the early stages of a government shutdown, which could force the Fed to make decisions with even more imperfect or delayed information on what's going on in the economy. And at the same time, tariffs are still working their way through the economy, and any unexpected spike in inflation could really force the Fed to delay some of these interest rate cuts. So while we see a lot of pressures on the Fed as it tries to keep the economy running smoothly, let's switch gears and turn to markets as we evaluate pressures that investors are also facing. Next slide, please. Okay, so one way to evaluate either how bullish or bearish investors are feeling is a price to earnings or PE ratio, where higher numbers suggest optimism and lower numbers suggest investors are a bit more pessimistic. At the moment, the bulls are kind of winning the race, as it were. So bulls are pushing PE ratios up. In some ways, that does add pressure on companies to deliver earnings growth. And so we'll turn to that on the next slide. All right. So we've seen calendar 25 stocks and sentiment are up a lot. Again, we're kind of in this bull market. And what does that mean? That means investors are expecting generally companies to deliver. They expect average or even above average profit growth. This chart shows what Wall Street estimates are for earnings growth in calendar 25 in red, calendar 26 in purple. Currently, the expectation is roughly 8% profit growth this year and a bit higher next year, around 13%. For context, if you go back several decades, the average earnings growth has been around 10%, which is pretty good if you go even further back. So it's been a pretty nice run. What we're seeing now is pretty close to some averages. So while companies appear to have recovered from some tariff-related pressures, you saw sort of a dip there in the spring on the Liberation Day news. Investors have high hopes that the S&P 500 can finish the year at the current pace of growth or better. So what's been driving all this earnings growth? Let's take a quick look on the next slide at one of the more significant growth drivers that we've seen recently. Next slide, please. So many of you are likely aware of the boom in AI spending that's really impacting a lot of parts of the tech sector. It's also impacting other parts of the economy and companies in electrical equipment, construction, or even power and utility sectors. We do expect this theme to continue as a driver for earnings and stocks in general. However, we'll touch on this in our positioning, we are taking a diversified approach. You wanted to make sure we own some companies in this space, kind of having exposure to AI, but also making sure we've got exposure to companies generating earnings in more defensive sectors, also other cyclical parts of the economy. So with that as sort of a bit of a intro to positioning, let's turn to the next slide and spend a little bit more on more broader portfolio positioning. Next slide, please. So I mentioned we have seen a bull market in stocks really this year and over the past few years for some balanced portfolios that has pushed the equity weighting above long-term targets. As we think about positioning, we do recommend sort of rebalancing back towards those long-term targets. Bonds continue to look attractive. Yields have been above where they've been for some time, getting somewhat compressed, but still relatively attractive compared to inflation. And we can take a deeper look at that on the next slide. So this is a quick look at the 10-year Treasury yield and sort of what we have now in the sort of low 4% range. You could look over the last 5 years or so. At the moment, they tend to look pretty attractive. If you look in the very short term, they've dipped somewhat, but compared to inflation, which is around 3%, compared to recent history, Treasuries do look fairly attractive, especially again for portfolios that maybe have excess equities. However, within bonds, Treasuries are looking a little bit more attractive compared to corporate bonds, where yields have compressed a little bit. Again, Treasuries looking a little bit more attractive here, but corporates have moved around, and we're continuing to keep an eye there. As those look more attractive, we may move back to that part of the asset class. With that, let's turn back to portfolio positioning on the next slide. So we touched on sort of balanced portfolios, the desire to make sure folks are having sort of a good exposure to bonds. If we go back to equities, one of the things that we've been looking at, we showed a couple slides ago, earnings growth. It's been generally pretty attractive in the US. We want to make sure we've got a good amount of exposure to that, sort of that durable growth in the US. However, we're also adding some diversification outside the US. We'll touch on sort of a compare and contrast in the next slide. In general, we're seeing international stocks kind of at the low end in blue, trading at less expensive levels compared to the US. Although there's a difference. We are seeing earnings grow much more slowly outside the US. And I think investors are giving an appropriate valuation to that. So a little bit less expensive internationally, a little bit more expensive in the US, but again, we have seen more durable growth. And that's something where we want to have some diversification to both sides. You can get more growth and less growth, as well as a little bit. Some of the stocks are more expensive, others are less so, and it kind of helps out in terms of diversification.
So Mike, I think this point tied back with the chart that you had in terms of the profitability in the U.S. So the developed international markets are trading at about 2/3 of the valuation or sentiment, right? Two turns to the 3 turns of the U.S. market. Is that fair?
Absolutely. Yep. So it's a significant discount. That's right.
And then the expectation for earnings growth, as you said in the prior chart for the U.S. this year, it's moved around because of the tariffs and whatnot, but it's coming in for calendar 25 at around 8% with an expectation of about 13% earnings growth in 26. And I guess the question is the valuation of the developed markets, does that kind of track to that differential? In other words, the growth rate ex US 2/3, is that the ballpark?
Yeah. So in general, it does depend on whether you want to look at currency adjusted or kind of strip
Sure.
currency out. So at the moment, if you were just to look at as a U.S. investor, if you're buying international stocks and saying, how fast are earnings growing? On the surface, it looks like earnings are growing, somewhere in the high single digits, from 7, 8, 9%, which looks pretty good. And you might say, wow, I'm getting the same earnings growth outside the US as I am inside, and I'm paying much less for it. Why wouldn't I go after that? The wrinkle is currency. So really, we've seen a weaker dollar this year. If you strip that out, Europe and other parts of the developed world are really not seeing a lot of earnings growth at all, kind of very low single digits. Some parts of the world, it's a bit negative. So it's not a clean kind of one-for-one ratio to say that international has a fraction of the U.S. earnings growth, therefore the valuation is a fraction. It does move around a bit. But for the moment, we're really not seeing a whole lot of durable growth outside the US. That will probably come back. We'll see a bit faster growth next year. But it does look like for this year and next year, the US will have faster growth. You're paying for it. There's sort of this premium in the US market. But again, thinking through diversification as you're getting some exposure outside the US, a little bit lower growth and a lower valuation multiple.
Great. Thank you.
Yeah, absolutely. So good questions there, and I think that really is a good summary in terms of what's available to investors. The U.S. market's been on this sort of bull run. We talked about AI driving a lot of the growth there. Some of the bigger sort of mega cap companies have been a big part of that earnings growth. And I think as investors, our desire has been to diversify, own some of those companies that are growing and exceeding, but also make sure we've got some exposure to some defensive stocks and stocks that are trading at slightly lower valuations. So with that, why don't we turn to the next slide with our concluding remarks. So our presentation has been a very quick run through in terms of what we've seen this year. It's been quite a year so far. We've seen tariffs. We've seen almost a bear market in the spring. We've seen a bull market now, and then we're in day one of a government shutdown. So lots of unexpected things. As we navigate through some of these economic and market pressures, we are trying to take a long-term perspective, not only on growth, but also compounding kind of year after year. So in general, we do prefer companies that offer some high quality characteristics, such as barriers to entry, durable growth, and market share gains, while also avoiding market timing and staying fully invested. So thanks for listening to some of our prepared remarks. And with that, let's turn to your questions. Mike?
Very good, Mike. Thank you. So again, for folks, the Q&A box is on the bottom of the bottom middle of your Zoom screen. Feel free to type in anything there that's of interest, and we'll try to get through what we can. So tied back into our short brief exchange there in terms of developed international and U.S., Mike, Alex asks if we expect continued U.S. dollar weakness, and I'll throw on, if yes, then maybe talk about portfolio positioning toward or away from international.
A great question. So figuring out currency, we could have thrown that out there as another pressure. Certainly a weak dollar is having a lot of impact. One part of that is if you're a U.S. investor and you own international securities, the performance looks better. So that is sort of pressure for investors who generally have a lot more U.S. investments. So thinking through, what's next? Could the U.S. market continue to weaken? A big part of that gets into interest rates. So, for example, if the U.S. has a much lower interest rate, you're going to see fewer dollars floating into the U.S. That's going to result in a weaker dollar. So we have to sort of think through some of those dynamics. The Fed is cutting interest rates, so that is one factor. If it continues to cut, there may be fewer dollars flowing into the U.S. to take advantage of those interest rates, and that could push the dollar lower. Other things that are happening, is there a recession? If the U.S. really slows down, that could also weaken the dollar. At this point, investors, I think the mainstream view is that we're not going to see a recession, but that's really something that could happen. And then things happening outside the U.S. If Europe has a big recovery, and we could see dollar fund flows back into Europe, and you could see a kind of a strengthening euro and therefore a weakening dollar. So a lot of moving parts, but in general, just looking at interest rates, I think there's a reasonable chance you could see a bit more weakness in the U.S. dollar.
Okay, and then maybe just talk about how that's kind of corresponded with some positioning we've had internationally over the last 6 months, please.
Yeah, absolutely. So, as we've seen this trend, another sort of type of pressure out there of changing interest rates, that is an area where we have added some international exposure. So historically, I think we've taken a view that the U.S. has had higher earnings growth, and that's been a great place to own stocks. That's been generally true for the last 10 or 15 years. However, there's a cycle, and so we could see a bit of a relative slowdown in the U.S., for example, and currency is part of that. So we've seen a weaker dollar, and that's made international stocks more attractive. As a part of some of those dynamics, we have been adding to international. Again, we talked about U.S. stocks, for example, being a little more expensive, international being a little bit less, but currency is a factor. And so we want to make sure we have some good exposure there. And that's one of the reasons we've added a bit to international equity exposure.
Great. Sticking within the risk asset class, I guess, in general, Brian sends in a question about overall opinion thesis on small caps given a decade of underperformance. He notes that at the index level, nearly half of small cap companies that are in the index are unprofitable. That would be referring to, of course, the Russell 2000. There are other small cap indexes. Maybe we want to talk about that for a second, Mike. carry higher leverage and remain more sensitive to rates. Any thoughts there in terms of, and maybe just describe our positioning, which is fairly neutral to broad-based markets.
Absolutely. So your kind of question is large versus small cap, and is small cap an area of interest? It has underperformed, but a lot of times that creates an opportunity to get back into it, and perhaps there's a cycle recovery, and perhaps small caps will improve. A few different things there. So yes, there are many of the smaller cap companies are unprofitable. One of the baskets of stocks or index is the Russell 2000. A lot more of those companies are earlier on in their kind of maturity process. Many of them are unprofitable. There's another index which we prefer, which is an S&P index, like the S&P 600. More of those companies, they're still small, but they're more profitable. So you get to strip out some companies that are perhaps have a higher chance of really struggling. Speaking of that, so one of the pressures on a lot of small companies are interest rates. So small companies tend to be riskier. Riskier companies borrow at a higher rate, so interest rates are a real concern. As interest rates really spiked up post-COVID, that was a big problem for smaller companies. However, we are seeing rates come down. We saw an interest rate cut last month. We're likely to see one at the end of this month. So that is something that can help small caps. We have seen a nice recovery in small caps over the last month or two, and so that could continue. So in terms of positioning, we've generally had sort of a neutral exposure. I think small and frankly mid caps, they hold a relatively light portion or small portion of the overall market. Large caps and mega caps have really just kind of dominated for some time. So we have a neutral approach, some exposure, and I think we're certainly open to risk and return. If it appears that there's an opportunity to get back in to small and or mid, that's something we'll take a look at. But at the moment, one of the things that we have been looking at is fundamentals. And so we showed on the chart, large companies are growing earnings 8% this year, maybe faster next year, we'll see. Small caps have really struggled. So if you go back to 24, earnings at smaller companies actually declined year over year. We haven't seen that in the S&P in a while. So even this year, small companies are struggling to grow anywhere near what we're seeing with large caps. So fundamentals a little bit worse. And one last comment, similar to U.S. versus international, small cap companies, the growth is a little slower. The valuations are also lower. So that's something where you can perhaps get in and own an asset class where if there's a recovery coming, there's a reasonable valuation.
Very good. Thanks, Mike. Couple here on Federal Reserve and just, overall market risk. I'm going to reword this a little bit. Given pressures on the Federal Reserve and their independence, how might that affect the general economy and I guess more broadly just the operations of the Fed?
Yeah, great question. I think this goes back to, we had a slide kind of on political pressure on the Fed. And I think historically, well, for most of its history, the Fed has generally been somewhat independent, certainly some different times in the 70s, et cetera, though that hasn't been the case. But investors really expect the Fed to act independently and not have some political decision makers kind of pulling the strings in terms of interest rates. So as investors are looking at, they're reading the same headlines that we're all looking at. Trump is recommending people to join the Fed, is pushing to get one person out of the Fed. That could impact Fed policy. Now, at this point, I would argue investors are not really taking some of those risk factors or potential changes and trading on them. So we're not seeing, I think, major concerns. If you saw that, I think the S&P would really be taking more of a hit. So really not seeing that at this point. However, investors are paying a lot of close attention. I think if there's a sense that the Fed is going from kind of being data driven to something else, whether that's politics or some other influence, that's a new risk factor that adds greater uncertainty. And investors typically price uncertainty by reducing that level of optimism. We show sort of PE ratios relatively optimistic now. I would expect that to come down if investors, from a mainstream perspective, really start to get concerned about kind of political influence. So not there yet, but really definitely worth watching over the next few months.
Okay, great. And this tied back into what you were saying. I think you actually mentioned that maybe consensus was no recession, but like what Neil asked, what the current likelihood is of a recession the end of this year or anytime in 2026 on a going forward basis.
Yeah, a lot of different numbers out there. I think there's one that we use the Bloomberg terminal. Got lot of good economic data there. I'm seeing a probability of recession of around 33%. As I look through some of the data, my sense is it could be a little bit below that, but a lot can happen. And so we threw out again the whole theme of the comments today was rising pressures. Tariffs. Tariffs are still out there. We could see more pressure there. We could push prices up. We're seeing the job market weaken, so that's an issue. This could be something where the Fed feels tied and they can't take any action because if they cut rates, that's bad for inflation, and if they do nothing, it's bad for jobs. We could get into something closer to stagflation, which happened in the 70s. You had really bad inflation, a lot of layoffs at the same time. I don't think we're going to get anywhere near that. But if you get closer to that type of challenge, you could get closer to a recession. It's certainly possible. Again, a lot of risk factors, government shutdown, let's say that lasts for a long time. Let's say there's more layoffs. Let's say there's something with the Fed and some concerns there with monetary policy. So a lot of things could happen. However, at the moment, I do think the sort of majority view is that we're unlikely to see a near-term recession.
Okay, good. I'm gonna combine a couple questions here. The core here is from Donald, and then another question that came in. Do you give much importance to charts in deciding when to sell a declining stock or will add or asset? And then how do you explain the move in the price of gold, which seems like a flight to safety? So
Yeah.
I'll start there, Mike. No, we don't give much importance to what a chart does. That doesn't mean we don't look at to see what a chart is doing to help us discern like what kind of money flow or weakness there is in a specific sector, asset class sector, individual name, in terms of just understanding what the flow is or the pressure. But we don't put a ton of degree of importance on that. Going and typically, I would imagine that the question is actually in terms of deciding when to sell a declining stock. So going to an asset class, it's going the other direction in terms of gold. What's happening there in terms of flight to safety and the move in the price of gold. For those who aren't aware, gold's up north of 40% probably after the last few days, probably closer to 50% this year. There's a long period of time there where gold didn't do much, right? There are periods of several years or a full cycle where the price of gold doesn't move. It's getting up near around $4,000 a troy ounce. um, and I think, and Mike, feel free to add in, but what's changed there in terms of again flows is over the last few years, um, and it has accelerated. Is central banks have been buying gold. So you think of, and certainly we tend to think of central banks as long-term owners of assets. Our own Federal Reserve still owns some assets that they bought way back in 2008 and 2009 during the financial crisis. And so there's the idea there's some long-term fairly significant dollars and cents that are buying gold. Another part of that is they're choosing gold, some at least in conjunction with what have been historically U.S. Treasury purchases, and in some cases in lieu of Treasury purchases. So I think that's one of the things that's happening. You're always going to have a retail aspect into gold in terms of investors as well. It's something we look at, something we consider as well as an asset class, and it is kind of within that safe haven type of investment. Mike, anything to add there?
Yeah, no, I think you handle it there in terms of the way we're looking at gold. I would just go back to the question on selling and looking at charts, other things. I think ideally for every stock that we own in a portfolio, there's an investment thesis. There's a story, there's a plan, there's a kind of financial model, and if a company has a problem, we can kind of evaluate that. If it appears to be a situation where that investment thesis, that story is broken, that's a situation where we would sell. So there's a lot of pieces that go into it. Certainly a lot of economic data and company financial data, competitors, et cetera, that we would look at. But those are some of the factors we evaluate when we consider a sale.
Yeah, good. Thank you. Um, and then Carol asked if you have gold like jewelry you no longer want, is this a good time to sell it? It's the best time to sell it on a dollar value basis, Carol. 4,000 a troy ounce is an all-time high. So Absolutely. And for those who'd like further reading on precious metals and those liquidating home goods, please look up the Bass Brothers and silver. So good question. Um, all right. Yeah, so this is I think this right now this is the I think the last one in the queue. So we'll answer this. If one or two more come up, we'll take them. As the Fed cuts rates, this typically is in anticipation of an economic slowdown. How do you square a Fed anticipating slower growth in a stock market that is fully valued? It's a fair question, for sure. There is a mantra, don't fight the Fed, which would mean that if the Fed is easing in terms of monetary policy, that's actually a good thing in terms of, for investors. Um, and then, lower rates. So let's talk about asset prices maybe in the economy. The Fed is trying to counterbalance two different parts of a mandate: stable prices, ostensibly those that are closer to 2% inflation than the current almost 3%, and full employment. And the employment picture has been iffy at best the last several months. 27,000 jobs, I think, on average, created on the private labor market in each of the last 4 months. So that is not a rosy picture, but to us, that gives the Federal Reserve actually, and if you read what the markets are saying, a higher likelihood that they will continue to lower rates. So there's that. They're using rates to help manage inflation and keep keep companies, able to have liquidity and capital to invest in terms of employment. And then if you think of it from a valuation standpoint, valuation is dictated by two things. The first is what Mike talked about on the front end when he talked about, the PE, the price to earnings, but the actual earnings or earnings growth. And again, the other piece of that is interest rates. And in theory, lower rate environment supports a higher multiple on that end. So the fact that rates are going down again would actually, you could argue, it's a more supported PE in the low 20s than it would have been with the rates higher. And so that's kind of how you square that, or rationalize, whatever word you want to use. But it doesn't mean that that there's no risk in the market. Far from it. There absolutely is risk in the market. And there's certainly pockets of the market. Mike mentioned the investment in AI. There are like tangential aspects of this where you look at where some of the multiples are, or pre-revenue models in certain businesses that are very, very, more akin to speculation than investment. And we typically don't participate in those with FBB portfolios with client capital. So, Mike, anything to add there?
No, I think that covers a lot of it. I mean, I think the one issue with looking at the Fed cutting and stocks up, I think investors are anticipating the Fed's going to sort of thread the needle and to be able to reduce interest rates, kind of keep a steady economic growth picture and avoid recession. So you could also wake up in a few months and investor sentiment could change and say, well, the reason the Fed is cutting is because people are the job market is weak, and so kind of looking at a little bit more of a historic side as opposed to the future sort of scenarios. But again, at the moment, if lower rates can help companies borrow more cheaply and continue growing, investors like that earnings growth. So as long as we continue to see that, I think that's something where you can have valuations remain at the higher end.
Very good. Those are all the questions we have. I guess I would remind everybody who's participating, who are clients, it is the fourth quarter, so you'll be getting some emails from us on fourth quarter items: charitable giving, required minimum distributions, qualified charitable distributions, anything within your annual giving plans, maybe some tax planning stuff around that stuff, around those different items. So we'll be reaching out, but don't be afraid to reach out to us either if there's any immediate questions on any of that stuff that's upcoming, and certainly any of the content that was covered here today. So we appreciate you spending part of your afternoon with us. Mike, as always, thank you. Katie, thank you. And I hope everyone has a great afternoon. Thanks so much. Goodbye.